to be a tool that I found to be helpful. When we look at Vantage Point data, we are looking at a series of data that is based upon intermarket analysis, the influence of markets on each other, on a target market. A neural network process determines the 25 markets that have the most influence on a target market, and then they reflect that influence to the degree of which the target market is being influenced in a set of intermarket data. When we look at the predictive indicators that we're going to talk about from Vantage Point, we are using typical prices. That's the average of the high, the low, and the close. Most analytical software, most indicators use only the close as their price point, but computer analysis has determined that typical prices are more useful for forecasts because they take into account the whole trading range for a day and not just one price at the end of the day. So when you look at the influence of the other markets, the neural networks forecast price direction. It's not a long-term forecast. You're not going to be able to look ahead and say, okay, this is the point at which we are now going to trade up forever or down forever. But this is a short-term forecast, and that's the most that we can expect to get, just as you can expect when you're looking at weather, for example. You don't get forecasts typically that will work for long-term. You have to kind of keep the short-term in mind, what is going to happen in the next few days. The chart that I have up here now is that 6-month gold contract that we used earlier. We'll talk about a couple of indicators. First, I need to set up the type of trading I do with the breakouts with a couple of other indicators that are on here. The first ones that I'm going to add, I'm just going to add a series of different types of indicators here that Vantage Point has and talk about them a little bit first before we get into the breakout type of situation. With the Vantage Point screen, we have several different indicators, and we're going to talk about each one of them in turn. We have the predicted moving average. This is a predicted medium-term moving average, which is that blue line, and you see that is going to be compared with the actual moving average, the simple moving average of the close, and that is that black line that you see there. When you look at these obviously, you can see where the trend has changed. Sometimes these moves are a little bit, long-term. I mean, it may not be particularly precise enough for what you want to trade, but we'll look at a couple of different points here that we can look at for the crossovers right here. Obviously the market moved up there, and then you have to wait for this move to continue. We have the situation over here where the market moves down. So you do have the moving average crossovers, very useful, very popular for a lot of different types of traders. To help determine, whether this is a valid trend change or not, there are a couple of other Vantage Point indicators. The first one we're going to talk about is the neural index. The predicted neural index is a comparison of two 3-day moving averages. In 2 days, will a typical price be higher or lower than it is today? If a forecast is higher, you're going to have a reading of 1. If it's for a lower typical price in 2 days, you're going to have a reading of 0. There's no in between. It's either up or it's down, correct or incorrect. That's the value of the short-term indicator that you see with the neural index. Again, it's helpful for getting into the market, primarily getting into the market on a short-term basis. I pointed out this plot right here where you had the turnover. Another very useful feature of the Vantage Point software is the predicted differences. The blue line and the green line on the bottom that you see are the differences between moving averages. The blue line is the comparison of a predicted and an actual, or a regular or actual moving average. That's a medium-term one. The green line is for long-term moving averages and comparing them with each other. And then you have the crossovers, which is a good leading signal that the trend may be about to change. There are a couple of other features that you'd like to watch when you're looking at the predicted differences. One is the angle of the lines. Are they moving up, down, sideways? Secondly, you also want to know where they are relative to this 0 line right here. Are they above it or below it? Effectively, what the predicted differences serve as a function of the momentum indicator. There are stochastics and there are some others that are kind of that measure the momentum. How strong is this move as it's moving up or down? Is there a lot of strength in this move? Is it worthwhile trading this move? That kind of thing. And so you want to have some corroborating evidence from your other indicators if you're going to signal. You need that evidence from the other indicators to indicate to you, what you want to do and what position you want to take. Now, as you're looking at the indicators and trying to determine what to do, you also need to take in rather subjective. It's kind of like you look at it and you don't really know for sure at what point you want to actually put your particular stop to buy or enter or whatever to get out of it. So what I'm going to do here is I'm going to add another one. Now, this is going to add a little bit of a element to the screen, and I hope you don't get confused by a couple of different lines here, but it's important as you go along to look at these lines to see how they relate to each other and how you might be able to trade these lines. Now, what I'm going to do is I'm going to take out the medium-term crossover line, that blue line and the black line there, and just cut straight to the predicted highs and the predicted lows. Predicted high is the gold line or the orange line. The predicted low is the pink line. That is forecast 1 day ahead. It provides a range in which the market can be expected to trade. Again, a probability. It's not like a guarantee that it's going to be there, but it is a probability of what could happen. Now, to get a little bit closer look at this, we're going to cut our dimension down to 2 months instead of 6 months and talk a little bit about it. Again, about gold, just kind of as you recall from the longer term chart that we looked at earlier, since the high that we had, I believe it was in January or earlier when we had the high above $1,200, the range of the market has, or the tendency of the market has been generally down. So we're looking at overall the trend down. So you want to keep in mind, there's always about 3 different trends you got to keep in mind when you are looking at a market. One is what's the big picture, the long-term outlook. Is that situation, going to be the most important, or is it going to be referred primarily to the short term, the medium term, which is kind of those little swing trade types of situations, or the very short term where you have the day-to-day fluctuations that would be more useful to the day trader or the intraday trader. In the case of gold, we're going to look at a couple of situations on the chart and talk a little bit about some of those as to how to use the breakout of the predicted high and low, that range, to determine where to get in and where to get out of a market. We're going to start right at the first of the year. There are some other points we could talk about earlier, but we're going to start at the